with the latest on the corporate front, all the market trends, expert opinion, and sound business advice. It is your unique window into the business world, direct from the heart of China.
Hello and welcome to Biz Today. I'm Zhao Yang in Beijing. Coming up, we will have half an hour of business news and analysis. On today's show, foreign investors are increasingly turning their attention to China's A-share market. Why the focus on Chinese assets? And we will also take a look at why the price of gold keep resetting record highs. And now let's begin with our top story. Foreign investors are increasingly turning their attention to China's A-share market with a particular focus on opportunities in AI and robotics. Since February, nearly 100 foreign institutions have been actively researching China's A-share listed companies. Goldman Sachs strategists have predicted a potential 15 to 20% surge in the value of China's stock market, driven by the country's rapid adoption of AI. China's tech innovation boom has driven re-evaluation of asset values. So why do international investors have such great enthusiasm for Chinese equities? And what's the trend for global cross-border investment? For more on this, join us on the line now are Li Lun, Assistant Professor at Peking University School of Economics, Chen Jiahe, Chief Investment Officer at Novim Archi Technologies, and also Yan Liang, Professor of Economics, Willamette University. So I will start with you. So foreign investors are turning their attention to China's A-share market. So tell us what's your feeling of this sentiment and why has China's stock market attracted so much global attention since February?
Well, I think we know that January the 27th, when the DeepSeek was released, I think that really, in a way, puts a lot of spotlight to the Chinese A-share markets. And it's not just tech, but tech is definitely one of the industry that I think received a lot of attention. So, globally, I think investors discover that China's AI industry is really making progress, making breakthroughs. And then related to that, other tech companies are also, being, I think, in a way, being put in spotlight. Also, the idea that the AI can be integrated in many of the traditional industries, and that would also help to improve, these companies' earnings and their performances. So I think it just revealed the potential of China's economy and its companies, and so that's why I think a lot more, investors are seeing China now as a desirable investment destination. And I think that is, in a way, on the one hand, there are some, investors are trading on the momentum. They're coming here for the technical adjustments. But on the other hand, I think people also start to realize that the long-term progress, the development of China's economy remains very solid. And also the Chinese stocks are largely still undervalued, right? You look at the forward PE ratio, right now it's trading at about 10, 11, compared to other countries like US and India, they're trading more than 20. So I think investors would just sort of discover, that this is an underweighted market and there's a huge potential, especially in the tech front and the integration of tech in the rest of the economy. So that's why I think that you're seeing a lot more investments coming in to the Chinese stock markets.
And Jiahe, so you are an experienced investor. How do you think about that? What's the reason that China's stock market attracted so much global attention?
Well, I would say there are a few reasons behind this. First of all, China is a stable economy with a stable government. I mean, if you look at the policies that China's government has been given in the past many years, you follow the lines of these policies, you can see that their policy is quite consistent with each other. So China's government kept on saying that we are opening to the world, we welcome global investors, we reduce the taxes, we support the private companies. If you look at their policies in the past 5 years, 10 years, 15 years, it's consistent with each other. So it's a very stable market. This is the first thing. The second is that China is really a large economy, which means from the level of economic scale, that means Chinese economy is much more stable than many other smaller economies around the world. And also for large capitals of the global capital market, this large Chinese economy means that you can invest billions and billions of dollars of yuan or pound into this market. You don't worry about the size of investment. You don't worry that this small economy might get some turbulence in the future. You're not worrying about all these things in China. You can just put as much of your money into China's economy as you like. And there's also another reason, as Yan just mentioned, is that China's valuation currently is pretty low. And also there's another thing is that if you come to invest in China, you're not worrying about the language. I mean, you can find many Chinese companies, especially if you look at Hong Kong market, every company that is trading there gives you information written in English. So you don't even have to understand Chinese to invest in China's market. You can just understand English and you can invest very perfectly in Hong Kong market. And even if you come to Shanghai and Shenzhen stock exchanges and you talk to local security companies, fund managers, many of their staff speak pretty good English. So you're not worrying about the language even. So that's all these reasons I think are supporting why China is a very good destination for global capital.
And so, Li Luan, actually, China aims to become the world's major AI innovation center by 2030. So given the rise of DeepSeek, what's your assessment of how China's AI ecosystem compares with other major AI countries or powers?
Yeah, so I think China's overall AI ecosystem is very healthy, as we are seeing new tech startups are attracting actually huge amount of funds and are developing very quickly. If we look at, for example, the humanoid robot manufactured by Unitree, which appeared on the Spring Festival Gala, the company Unitree actually is under 10 years old. So it's founded in 2016. So within 10 years of time, it has developed into one of the largest manufacturers of humanoid robots. And they basically, and the surprising fact is that they only took like 6 months to develop the humanoid robot that we're seeing on TV from scratch. So they basically, before that, they were only focusing on the robot dogs. So those manufacturing developments and breakthrough have indicated that the AI technology is making fast developments in both the robots and also in drones and also, for example, low altitude aircrafts. And these indicates that China is potentially going to have the widest adaptation of these technology in manufacturing and also in other consumer markets as well, and also a surprisingly low cost. So all of these outlooks are indicating that China is basically having a bright future in AI's development.
And so, Yan, China has recently rolled out a new action plan to stabilize the foreign investment. Among all the measures, the plan encouraged the long-term investment in China's public listed companies. So what do you make of that?
I think it makes a lot of sense. I think this 20 points action plan is to attract but also stabilize foreign investment. And it's, as we know, that now China has basically removed all the restrictions of foreign direct investment in the manufacturing sector, but also pledges to open up more the service sector, including telecom, healthcare, and education. So I think it makes sense to use these stimulus plans or actions to attract more investments coming into China. And I think the emphasis on long-term investment is really rightly emphasized, because we do know, for example, Goldman Sachs has estimated that there are a lot of hedge funds now are buying the Chinese investments, and especially in February, which is, again, I think on the one hand, it is good to attract some of these investments in the short term, but more importantly, I think we need this long-term investments that would really help to bring in technologies to boost the competition domestically and really try to improve the long-term performances of the Chinese companies and the market. So I think this idea of attracting long-term investment, it's really the right strategies to go.
And Jiahe, so what do you make of that? And how do you see the foreign equity investment here in China going forward?
Well, when we look at foreign investors in China, I think they're taking quite a large of advantage in China's market. We actually got a lot of data for, there was a certain group of foreign investors called qualified foreign institutional investors. They got a quota to invest in China. And that investment period lasted for almost 2 decades. And we did a research about their record. And their performance was excellent. They beat it about 80% or 90% of the local institutional investors in our data. And they got a pretty good return. On average, I think they got something like 8 to 10 times return within about 15 years' time. So that's a lot of return, and there's a lot of extra performance, which we call, it's, for example, if you put your money into a market and this market rose by like 3 times over a decade, and it got 5 times return, that means you got 2 times extra return. So that's, that's the reason why a lot of foreign investors are making quite a good fortune in China.
And yeah, so we've seen that worldwide, the cross-border investment remains weak due to slow economic recovery and particularly the stagnant growth in developed economies. And additionally, Trump's tariffs are expected to make the global economy fragmented further. So what's the outlook? Are we going to return to the pre-globalization era when each country had to be more economically self-sufficient? Or what should the international community do to improve the global cross-border investment and economy?
Well, that's a great question. So I think according to the UNTAC data, FDI has declined by 8% in 2024. So you're right, with the geopolitical uncertainties and with some of the protectionist policies, we're likely to see more fragmented market. So I don't think that deglobalization is really the trend. But I think regionalization, right, and fragmentation, which means, you could have countries that are trading with each other that are more sort of the so-called like-minded, or they're more in the same kind of camp, and then reduce the trading between the blocks. So I think according to the IMF, right, this kind of fragmentation is really going to damage the global economy. So the estimate is that if you look at the trade fragmentation and investment fragmentation, that's going to reduce the global GDP by 7% in the few years. And if you add the technological fragmentation, then that could, shed GDP even more by about 13%. That was their 2024's estimates. So I think, this is not going to be favorable, especially I think for some developing countries that would like to join the global trading and investment system and to attract foreign direct investment. And now I think that prospect is becoming more bleak. So I think to your question, what should be done and what can be done, I think for the global investors community, I still think that investment, it's global investment, cross-border investment, is still a business savvy thing to do, right? Because you are able to tap into bigger market, you are able to join, to be able to acquire more sort of market sales in other countries. But I think more importantly, now, for example, in China, it is also a developing and progressing kind of a technological ecosystem. So I think a lot of companies come to China not just for the markets, but also to be able to join that technological ecosystem, the innovation system. So I think it brings a lot of benefits for the global investors to not only diversify in terms of the risks, but also their markets, but also to join the kind of technological collaborations with companies from other countries. So I think that is still good. Now, when it comes to government, I think, the Chinese government has just rolled out this plan to attract more foreign investments and made the policy environment more conducive to global investors. So I think that is really the right thing to do. Whereas I think, on the other hand, Donald Trump does want to bring more foreign investors. But the way he does it is through the tariff threat. Right, to say, if you don't come to my countries and invest here, I'm going to tariff you. So I think that's going to make policy environment a lot more uncertain and opaque, and that is not necessarily conducive to more foreign investors.
And Jiahe, so as an experienced investor, how do you view the U.S. and China, the real economy, and also the stock markets right now?
Well, I think one of the largest questions a lot of global investors are concerning right now is that, are you going to keep on investing in the United States, or are you going to turn your investment to China? So that's a very large question. My personal answer is, it's not expressed by my words, but by my portfolio. I got about 100% of my money invested in China, about 15% in Asia, and about 85% in Hong Kong markets, but all in China's companies. But I mean, if you look at the difference between the United States and China right now, is that if you look at the potential for economic growth, China is definitely having a much larger potential compared with the United States, which means companies here will have more growth potential in the future. That's basically because China is having a per capita GDP that is much smaller compared with the United States. So that means if you look into the future, the growth rate of China's income, the consumption power, the per capita GDP will outpace the United States by a very large extent. That happens with the developing economies. And another reason is that China's valuation is just much cheaper compared with the United States. I mean, currently my portfolio is having a average PE ratio of less than 7 times. I think it's 6.5 or something. And if you look at the relative companies in the United States, are trading at about 20 to 30 times PE ratio. So I think if I go to build a portfolio in the US, I would get an average PE ratio of at least 20 times or maybe 25 times. And it gets 6 times PE ratio here, you get 20 to 25 times PE ratio there. It's not really a hard question to answer about whose return in the future will be larger. So if I'm managing a money that's selecting the two destinies of my investment, I would definitely say China at this very moment.
Mm-hmm. Well, we're speaking with Chen Jiahe, Chief Investment Officer at Novem Archi Technologies, Li Lun, Assistant Professor at Peking University School of Economics, and also Yan Liang, Professor of Economics, Willamette University. And after a short break, we'll take a look at gold prices. Stay with us.
As one of CGT and radio's most popular programs, World Today provides listeners with a strong mix of international news and business. It delivers in-depth analysis of current affairs and one-on-one interviews, bringing you the stories behind the news, not just what's happening, but why.
Welcome. I'm Elaf Ellard, economics professor and member of the Data Science and AI Center at New York University, Shanghai. On the World Today program, you can find in-depth and impartial insight, as well as critical commentary on key trends in the Chinese economy, financial technology, business, and blockchain. To prepare for the world tomorrow, join me on World Today.
You're listening to Biz Today. I'm Zhao Yang in Beijing. Gold prices have maintained record highs recently, driven by concerns over inflation and the potential for global trade tensions following U.S. President Donald Trump's tariff policies. The U.S. Federal Reserve's latest meeting minutes also emphasized inflation risk, reinforcing expectations of a prolonged pause in interest rate cuts. So actually gold prices are already up 10% this year, extending the gains from last year. So what are the key factors sustaining the gold strength in the current environment, do you think?
Well, we know that the gold supply is relatively constant over time, but the demand could be very variable, right? And that's what we're seeing. And when it comes to the gold demand, it's mostly used for jewelry, for technology, and more importantly, now I think driving the changes are for investment purposes, but also for central banks' reserves. So we're seeing that because of the current situation in the global economy, with Donald Trump's very precarious policies like tariff threats, and also its domestic policies like very expensive tax cuts that would increase the federal budget deficit by $4.5 trillion in the next 10 years. So there is a concern about inflation. So the idea that gold would be relatively stable in its price, as a matter of fact, increasing its price over time, I think that becomes a very desirable vehicle for investors to park their money and invest their money into gold. So I think we're seeing the large demand for gold for investment purposes. But also central banks have been trying to diversify away from the dollars. Again, there are many reasons behind. There's due to the economic reasons. You don't want to put all your eggs in one basket. So you want to diversify away from the dollar as your reserve currency. But there's also geopolitical reasons as the United States waged the sort of the economic weapons, right, that weaponize the use of the dollar and freeze the Russians' dollar assets. That I think stoked some fears on many of the central banks in the world, that they worry if they put the reserves all in the dollars, then that might be at risk, right, if they have any sort of friction with the United States. And that's why they're also putting up buying a lot more gold reserves. Central banks in India, China, Germany, and so on and so forth, they have been buying a lot of gold. So I think those are the reasons that we're seeing, rising demand for gold, coupled with the relatively constant supply. That's why we're seeing gold price have been rising. Like you mentioned, last year it rose by 27%, which is the biggest rise in 14 years. And it's very likely that this year we're going to continue to see the increase in the gold price.
And Jiahe, so the US dollar is often seen as the global reserve currency, and gold tends to move inversely to the dollar. So how do you think the dynamics between gold and the dollar will evolve?
Well, when you compare gold and dollar, gold is definitely something that reserves your purchasing power. If you look at the past half century that we passed away from the gold standard back in the 1970s, gold has always reserved money for everyone. Gold is much better than most other things like diamond, silver, whatever that is. But dollar is just a paper money. So especially if you consider the fact that the United States has been printing so much dollar in the past few years, shooting up the monetary reserve, shooting up the inflation. So people, and especially when you look at the U.S. government has been holding a large debt to the world, to domestic investors and global investors as well. So people started worrying about the value of the dollars. This concern has been quite a long period of time. After all, it's just a paper money. So the confidence toward paper money comes from the confidence towards the trading status of an economy. And if you look at what the U.S. government has been doing in recent months, it started waging a lot of tariffs against I would say all countries around the world. There's even an argument saying that Canada should be, merged by the United States and become another state. So this kind of things just reduced the global traders and investors' confidence toward how stable the United States can be with the global economy and how stable the trade can be. So this is something really worries people. This worry doesn't happen with the gold. Gold is gold. It's always been there. It's not going to set trade tariffs on you. So that's the reason why people are starting to worry about the dollar, and you see this very large divergence between the gold price and the dollar.
Mm-hmm. And Yan, so the recent U.S. inflation data came in, of course, hotter than expected. And in the meantime, the Federal Reserve Chairman Powell suggested that the Fed was not in a hurry to cut the interest rate. So how do this message affect the appeal of gold?
Well, I think the inflation and the inflation expectation would definitely push more demand for gold, right? Because the idea, again, as we mentioned earlier, that when general inflation rises, people are more willing or more, or they want to park their money in gold because the value will sustain and it will increase. So that would reduce the impact of inflation on their real wealth. So I think that would, in a way, increase the appeal of the dollar. Now, in terms of the Fed's decision not to cut interest rate, I think that would, in some ways, interestingly, have mixed effects in terms of the gold demand. On the one hand, the idea that if the Fed keeps the rate higher for longer, that's going to help to, in some ways, reduce inflation or mitigate that inflationary pressure. And so that would make the gold less appealing because if there's not as much inflation, so you don't have to, buy more gold, so to speak. But at the same time, if the Fed does not cut the interest rate, that means the dollar value is going to stay stronger, right? When it comes to its exchange rates with other currencies, it's going to maintain its value better. So that again would, in some ways, reduce appeal to go for gold, right? Because the idea is that if you hold the US dollar and it will stay strong instead of depreciating, then it is okay to have more of your reserves in gold or have your more investment in the dollar assets. So I think there are many, interesting, I think, this sort of effects. But again, in general, if that inflation remains elevated or the expectation remains elevated, then that would definitely strengthen the gold value by pushing up the demand for it.
And Li Lun, so as gold prices approach new records, are we seeing the return of a gold rush mentality where people begin to buy simply because others are buying?
Yeah, right. That's a great question. So we have to be able to distinguish between, whether the demand is driven by strong market fundamentals or, driven by speculative behavior by, the consumers. So right now, I think as the other guests have correctly said, I think the gold demand are mostly driven by people rushing to safe haven assets and want to preserve their wealth in face of inflationary pressure, especially in the U.S. So I think right now we're not seeing, for example, a large demand of gold by consumers in the consumer market. So I'm tending towards that this bullish market in gold is mostly driven by risk-averse investors trying to preserve their asset instead of people buying because of this herd mentality kind of thing. But of course, we have to keep watching because a speculative bubble can be a self-fulfilling prophecy. If the gold prices continue to rise above the $3,000 per ounce threshold, we may be seeing more consumers rushing to the gold market, and we may be seeing we're actually already seeing some Chinese consumers getting more and more interested in gold decorative gold jewelries and other stuff. So we have to keep watching, but overall right now I don't think we're seeing a speculative bubble, especially at the consumer market.
Well, we're speaking with Li Lun, Assistant Professor at Peking University School of Economics, Chen Jiahe, Chief Investment Officer at Novem Archi Technologies, and also Yan Liang, Professor of Economics, Willamette University. And that's all the time we have for this edition of Biz Today. I'm Zhao Yang in Beijing. Thank you so much for listening.